Am I the world's worst investor? Of course not. I just did a video on driving $50 per month in passive income from dividend-paying stocks. I use Procter Gamble as the example. I'll link in the description below if you have not seen this video already. And I showed how right now in 2018, if one were just getting started out, one wanted to drive $50 in cash flow and passive income per month through dividend-paying stocks, one would have to invest $16,574.59 in Procter & Gamble, a stock that I own, by the way. And so when I did this video, this is a popular video. I'm really grateful for that. I'm so grateful for the growing community here. We are all dividend investors supporting each other in our journeys towards passive income, financial freedom, whether it's full financial freedom, where dividends cover everything, or even partial financial freedom, where the dividends help supplement bills and create a better lifestyle for all of us. And so anyways, I did this video. I got a lot of comments, and some of the comments literally was from other YouTubers saying, hey, I'm going to do a video response and I'm going to show you how I can do even better than Ian. I'm going to show you how there are other ways to drive $50 per month through different stocks other than Procter & Gamble that might be better. And of course there are ways to drive $50 per month with less capital invested. And so the purpose of this video is to show some different scenarios and show, quite frankly, why I chose this. Why did I choose Procter & Gamble? In a nutshell, you will see out there on the internet, there are people who have Lamborghinis in their videos, there's bells and whistles, there's all kinds of stuff going on, there's wild expectations of getting rich. That is not this channel. This channel is about a slow, methodical, conservative way to build financial freedom. And I'm literally documenting my personal journey here. I've been doing this for over 20 years. I've seen it all. I've tried it all. I've literally tried most of the investing strategies out there. And where I have arrived at this stage in my life is setting realistic expectations, modeling conservatively, and quite frankly, just not having a lot of the hype that one can see out there on the internet. If you want the hype, you want the get rich quick, that is not this channel. That's not what my personal journey is about. My journey is about being realistic. And so quite frankly, why did I choose Procter & Gamble? It is realistic. This is a realistic stock. It's a middle of the road stock. One can certainly drive $50 per month quicker, but I'm going to share today why did I pick this middle of the road stock in my financial freedom, in my passive income video. And of course, just like the last one, if you saw that video, again, I'll link in the description below, I shared how I used to have a passion for Louis Vuitton products. Well, check it out. Got a box there. We'll share that a little bit later today, what's in the box, and let's get started. So before we get into anything, just a quick refresher. We want to drive 50 per month in passive income through dividends. I want to do that. How would I do that? Well, one way to do that is to buy Procter & Gamble. It pays $2.868 in terms of dividends per year. It's paid quarterly, actually. And if one takes that, the current price per share is 79.2. Actually might be a little different than this. I'm pulling the Procter & Gamble data that I used in my last video from a few weeks ago for consistency's sake. So the price per share might have changed a little bit since then, but close enough. The yield, dividend yield, how do we calculate that? It's the dividend per share, the quarterly one added up for the whole year, divided by the price per share gives us a yield of 3.62%. 3.62, it's nothing to write home about, but it's also not bad either in the historical context of Procter & Gamble, a reasonable yield. I want to drive, in passive income, PI stands for passive income, 600 per year. Well, if I take my 600 per year, I divide by 3.62, it gives me exactly what I need to invest. What do I need to invest? I need to invest $16,574.59 in Procter & Gamble stock. If I invest that today, I get $600 a year or $50 per month. If I take my quarterly dividends, smooth them out per month, $50 per month. That was the example shared last time. Why did I pick this example? I picked it because this is a blue chip company. It's a company I talk a lot about here on my channel. I like it. It's reasonably stable. It's big. In my opinion, it's not going to go anywhere anytime soon. It's a nice, stable, middle-of-the-road company. Quite frankly, that also grows its dividend over time. We'll get to that in the second chart. We're going to talk about that in a minute. But I picked this also just because it's kind of conservative. It doesn't have a sky-high yield. It doesn't have a low yield. It's kind of middle of the road. And whenever I model stuff out, whenever I model anything, I like to look at things realistically, conservatively. That's just who I am. That's just how I am. I think it's an important trait that I bring to YouTube, that I bring to the internet, because not all channels are like that. Not everyone is like that. And so I'm trying to bring a dose of conservatism, financially speaking, to the mix. And so 3.62 PG, yeah, could I drive $50 per month in cash flow by investing less money in another stock that yields more? Yes, absolutely. And so I want to give some examples of that today, but I also want to just share as I go through this why I picked PG, Procter & Gamble, because I think it's kind of a middle-of-the-road stock in terms of having some dividend growth, but also having some stability, also having a big blue-chip brand name. It's kind of got the best of all of these worlds. And so when one factors in risk, when one factors in the long-term dividend growth, certainly, in my opinion, this is a reasonable place, for me at least in my journey, to look when I'm trying to drive $50 per month. Anyways, let's look. Another company I own, Southern Company. I'm going to link in the description below. I own this stock, Southern Company. It's a regulated electric utility. I love these guys. The dividend growth tends to be a bit slower with them. As is characteristic with the utility sector, the current yield, because one doesn't see as much dividend growth, and just because it's a utility, it has a higher dividend yield. So let's look at this. Southern Company dividends per year is $2.40. The current share price is 49.22. The current yield, how do I calculate that? I take the dividend, I divide by the price per share. The yield is a 4.88%. So off the bat, we know for money that's deployed today in Southern Company, it earns more dividends in the short run than Procter & Gamble. Why? Because the dividend's higher yield. Why is it again? Slower growth company, less opportunity for upside over the long run than something like a Procter & Gamble. Quite frankly, in terms of stability, probably somewhat similar, but you know what? It is a smaller company than Procter & Gamble. It's geo-focused. It's in one particular geography in the southern states. And so the fact of the matter is Procter & Gamble is a bigger company and it's global. And so it may be that one would say Procter & Gamble might have a little less risk. That said, I'd say Southern has pretty low risk because it's regulated utility. It's not going to get disrupted very easily. Anyways, one gets a higher yield, but less upside, in my opinion, over the long run. So let's say I want to drive passive income, $600 per year with Southern. If I take my 600, I divide by the yield, which is 4.88%. It tells me how much money, Ian, do you have to invest today to receive $50 a month or $600 a year right now? Well, I have to invest $12,305. So obviously there are examples out there that are better than Procter & Gamble. But again, the last video is for illustrative purposes. I was trying to illustrate a point. I was trying to use a conservative example. I was not trying to come across as someone who is picking the wrong stocks or ignorant or does not know how to invest. Obviously, I know all of those things, but I'm a very conservative modeler and I'm very conservative in my journey. And so if you've been following me for a while, you know that I have a portfolio of 37 stocks, probably adding a 38th pretty soon. We'll talk about that a bit later. And they have all kinds of current yields, some higher, some lower. Nice middle of the road stock. Here's an example of a higher yielding stock where I only have to deploy $12,305 to get my 600 now. That said, we'll see in a minute, there's downsides that come with that. Over the long run, the dividend growth is slower, and so yield on cost over the long run is going to be slower, and we'll talk about that later. Another example, Fun. I am really intrigued by this company now. I'll link in the description below. I have a several-part video series in the works. I actually had the first part is live already on that. I'm analyzing this company. I'm thinking about buying it as my 38th stock. There's so many interesting nuances with this company. I would consider Fun, Cedar Fair, as a riskier company. They operate amusement parks in the greater United States. They got one in Canada as well. The stock price has a history of some volatility, especially during economic cycles, and it's because they have a lot of debt. The debt, the markets are sensitive to the amount of debt they have. I'm going to cover all of this in a future video. I'm actually about halfway through preparing for it now. I have not decided, by the way, whether I'm going to buy this company or not. I'm kind of still in the thick of my analysis, but I love how the stock keeps tanking. Better and better starting yields. And so I'll link in the description below to the first video on Cedar Fair. There's going to be more coming out, so just stay tuned. I'm real excited, real excited about that. But anyways, here's a riskier stock. What do I get for risking my money, for being a little riskier? This is a small cap. Market cap is just under $3 billion. Small, real small, for me at least. Dividend is 3.56 per share, or here it's called a distribution. It's a unit because it's a master limited partnership. There's actually tax advantages here too, and so this yield is actually even better than it looks because there's some tax advantages as long as one here is investing in a full taxable individual account. Anyways, price per share 51.21, or I should call it per unit because these are called units because it's a master limited partnership. Take the unit price, or I take the dividend or distribution price, divide by the unit price, I get the yield, 6.95%. I can get a starting yield right now in 2018 of 6.95. Okay, I want to drive 600 a year in passive income. Take my 600, I divide by 6.95, bam! I only need to invest $8,630.90. That's a lot less than Procter Gamble. That's about half. And so this is the point I'm trying to illustrate. There are a lot of different stocks that one could pick, but in my video, again, I chose this for a reason, folks. There are a lot of people here who are just starting out. There are a lot of people who are just starting to get their hands around passive income, financial freedom. This is not the YouTube channel with the Ferraris and the Lamborghinis. This is the YouTube channel where I am sharing my 20 years of experience and I model conservatively and realistically, and that's why I chose Procter & Gamble. Anyways, Procter & Gamble, it's a core position in my portfolio. It's a real core, big position. When I say core, it's one that I really double down on, I really believe in. Even if I add Cedar Fair, it's probably always going to be a small position. This is a riskier company. I'm not going to make it a core position. It's riskier. I like to pepper in some of these riskier companies because they help elevate the weighted average yield of my whole portfolio. But if I was just hypothetically getting started out, I probably wouldn't be looking at it quite as closely. That said, it's a reasonable value now, and so I'll link in the description below. I'll talk about, I have a video there where I discuss my investment philosophy, and one of the buckets of stocks I like to buy are kind of beaten down, opportunistic, deep value companies. And there's a place for deep value in my portfolio, and this certainly isn't in deep value territory yet, but it's off its highs from 30%. So anyways, I don't want to spend too much time on this, but this is the difference. I can drive 500 per month, or 600 per year, 50 per month with less capital invested. No brainer, it's easy, but there is risk that comes with that. There is a difference between investing in Cedar Fair and Procter & Gamble. We're talking about a multi-$100 billion company, global distribution, tons of products, versus the amusement park company in the United States that owns, I think, 12 or 13 amusement parks. And look, I love all these companies. They're great. I'm not trying to put down Cedar Fair. I'm just saying there's a difference between investing in Procter & Gamble or even Southern Company versus something like a Cedar Fair. And that's very, very important, in my opinion, for myself, for others, for anyone considering investing for dividends, for passive income, to keep that type of thing in mind. So let's look at another example. I love this example. Maybe I should have picked this one. In hindsight, just to drive home the point, I was picking this for a reason, to drive home a point. This one drives home the point even better. I probably should have picked this one. 3M, ticker symbol MMM. They make Scotch tape, so many other things. I love these guys. I started buying them for the first time in 2018. I'll link in the description below. Okay, dividend is 5.44. Price per share, 206.93. Wow, that yield's not that good, 2.63%. That's real low. If I wanted 600 per year or 50 per month, I take that, I divide by my 2.63. How much do I need to invest right now? I need to invest $22,823.16. I must be the world's worst investor if I pick that stock. I must be a horrible investor. No, we'll get to it in a minute. It's all about the long-term dividend growth, but more than that, it's about this company being somewhat disruption-proof, in my opinion. This is a great company, a pillar company. This is one right now that's a small position in my portfolio. I expect it to get to medium and then core over the next few years as I continue to add to it. I love this company. I can't believe I waited this long, but it happens, it happens. And so anyways, though, I should have just done my last video on this one. Hey, hypothetically, I want to drive 50 per month right now. I need to invest 22,000. You know, I didn't pick this stock because it's not middle of the road. It's a lower yielder, but I love these types of companies because they grow the dividends. And so I want to pivot into that next. So that's table one. And if someone needed their money tomorrow, I don't need my money for a while. So I'm reinvesting all my dividends. I'm waiting. I'm really looking at yield on cost. I'm looking when I do start tapping into my dividends, what's my yield on cost going to be? Because this is all about current yield. This is literally for someone that wants to retire tomorrow. And someone that wants to retire tomorrow, probably what I would, for me at least, if I were in that scenario, stocks like Southern Company become really, really, really attractive because that current yield is there, but it also has that stability. But you give up some dividend growth. Stocks like 3M, maybe not quite as exciting because the current yield is lower, but the growth is there. So let's move on. This chart is what it's all about. I looked back just over the last 5 years, not too long. How much have these companies grown the dividends over the last 5 years? And so the first one, Procter Gamble, grew the dividend by 19.3%. Not that great, but not bad. That's a good 5-year growth rate. Southern Company grew it by 18.3%. This is actually an interesting point. This is one of the reasons I love Southern Company. They're one of these conservative utilities, but they have still inched out some serious dividend growth, and so love these guys. Cedar Fair. They've grown the dividend by 42%. I put a star here, though. The reason why Cedar Fair, they had to actually cut the distribution during the trough of the Great Recession. I'm going to get into that in a bit in my next Cedar Fair video, coming real soon, real soon. The dividend growth is probably higher than it'll be going forward because they've built it back. They've got it back and then some. They're at new highs in terms of distribution, but that's why I put a star. 3M, though, 114% growth. The dividend has grown. It is more than doubled in the last 5 years. It's hard for me to wrap my head around that this big blue chip company has done that, but they have. And so the fact of the matter is current yield is one thing. Current passive income, great. But what's it going to be in 5 years? What if you don't need your money right now? What if I don't need my money right now? What's the dividend going to be in 5 years' time? In 5 years, that's not that long. Think about what could happen in 10 years, 20 years, 30 years. That's where it gets real interesting. But I picked 5 years just because it's easy, quite frankly, for me to pull that data from NASDAQ website. And I think it's just 5 years is a long amount of time for a lot of people. And so let's just look at 5 years. 5 years out, what does the dividend become? How do I calculate this? Well, I know what the dividend grew by. And so what I do is I take the old dividend and I multiply it by the sum of 1 plus 0.193. So 1.193 in the case of Procter & Gamble. That's how you get the new dividend, what it'll be in 5 years. If the big assumption here is if they continue the same rate of growth, they may or may not. Who knows? But past data is all I've got. The new dividend is 3.42 for Procter & Gamble, 2.84 for Southern, so on and so forth. The big difference you can see is 3M goes from a 5.44 to an 11.64 if they can keep this up, if they can grow the dividend by another 114%. Okay, I know that my new dividend are much higher, much higher. And so what I do now is I calculate my cash flow 5 years out. How did I do this? Well, basically what I did, I have one column missing on here. I calculated how many shares do I need to buy. The way I did that is I took the amount of money I'm investing, I divide by the price per share, and it's not per trade year, but I get the number of shares I invested in each of these hypothetically in table 1. I take that number of shares, I multiply it by the new dividend payout per year, and bam, I get the 5-year out cash flow. 5 years out, if these companies have the ability to raise the dividends the same amount they did in the last 5 years, and who knows if they will or they won't. Cedar Fair I starred, quite frankly, because I don't know if it will, because it had a unique case. But what happens is the cash flow for Procter & Gamble becomes 716.04, cash flow for Southern 709.8, cash flow for Fun 852, cash flow for 3M 1,284. This is the magic right here. If there's one thing you take away from this video, this is the magic of dividend growth investing. This table is fun. This table is cool because dividend growth investing, it's so compelling. As soon as someone gets started, cash flow rolls in. But the real cool table is this one, because cash flow right now, yeah, it's nice, but what's it going to be in 5 years? Well, in 5 years, it could be a lot higher. And then I calculate yield on cost. Yield on cost is simply I take the cash flow I'm getting and I divide by my purchase price, by amount invested, the original amount invested over here. Yield on cost for Procter & Gamble is 4.32, 5.77, 9.87, and a 5.63. So you can see very quickly here that, yeah, 3M, it kind of has a low yield now, but if one buys, holds for the long term and they continue to have great business results, that's the big assumption, and they continue to raise the dividend, that's the big assumption, bam, yield on cost is going to be real good. Just in 5 years, it'll be over 5%. That's pretty good for 3M. And then think, what's it going to be in 10 years or 20 years or 30 years? And so this is the magic of dividend growth investing. And so when I go back to the comments, I don't want to come across negative or critical here. I love this community. I am blessed. I am grateful. Everyone here, everyone subscribing, participating, it really means the world to me. And I've said this in prior videos, but I think about you guys all the time. I really do wish you well. I wish everyone here tremendous success. And that's what this community about, is empowering each other. But I just had to do this video because I got a lot of questions, and a lot of them were genuine. 99% of them were genuine, quite frankly, and I'm blessed for that. There's 1% of the comments out there that was literally, Ian, you don't know what you're doing, or head on over to my YouTube channel where I'm going to show you a different way of doing it. And that's fine. Look, I want to have a discussion here, a debate. That's great. But look, you guys, I'm sure the people out there doing these comments and videos, they know better. Come on, I've been doing this over 20 years. Obviously, there's a way to drive more passive income in the short run than buying Procter & Gamble. But look, there's a reason behind everything I do. I'm a very calculated businessman, investor. I'm thinking many steps ahead. And this is the reason, and these are the trade-offs today. These are the types of trade-offs. And the other thing is, quite frankly, obviously one could pick a basket of these. It doesn't have to be one or done. I picked one stock, again, for illustrational purposes, to make it easy illustration. But it doesn't even have to be these stocks. It could be a basket of stocks to drive $50 per month in cash flow. But the fact of the matter is I want to keep it simple here, conservative, easy to follow, easy to understand, because we do have a lot of new community members here. The subscribers keep growing as well. And so I've got to mix some of the advanced stuff with foundational stuff and make sure everyone can grasp these concepts here that are being discussed as part of my financial journey. And so anyways, I hope you enjoyed the video today. I really appreciate it. Hey, before we go, let's check this out. What I got here? Oh, Louis Vuitton. So I have some subscribers that you guys crack me up. Someone was saying, hey, Ian, I've shared some of my things on this channel. I shared in the other video that I referenced the Louis Vuitton bag. And the purpose I share it is to share the old Ian versus the new Ian. And look, the new Ian still isn't that great with my budgeting. I like to buy stuff, but I've certainly gotten better than these days. And so we'll look at this in a minute. But the reason I share these luxury goods is, if one buys these luxury goods, let's even go with the base case. Cheapest way to get the 50 per month is 8,630, at least the cheapest way shared here. This is also probably out of all of these the riskiest way. But let's say that's the route, hypothetically, that one wants to go. Saving $8,600 is really hard, really hard when one buys into this keeping up with the Joneses or keeping up with the luxury goods, or even doesn't buy into that. They just like them like I do. They just like this stuff. Well, it's important to show some self-restraint. And once one reaches financial independence, financial freedom, maybe there's some rewards that come later. But you guys crack me up because one person was, Ian, bring out your Rolex. Look, I don't have a Rolex. Maybe one day, but no, I don't have that. And then another person was, get out your Hermes belt, or I don't have that either. But I do have a history with some of this Louis Vuitton stuff. So let's see, what do we got here? I got the nice, it's got to have the bag for the shoes. But what I got here in this bag are these shoes. And so I really like these shoes, actually. I bought these a while ago, and I got a lot of use out of them. But you can see right there, they have a nice leather shoe. They got the Louis Vuitton monogram kind of classical pattern there with the LV and the stars and such, and so four-leaf clover, all that good stuff. And so these are actually pretty good shoes. I've had these a while, and I've used them quite a bit, so I got a good useful lifespan out of these. But the fact of the matter is if you go out and you buy a bunch of products like this is kind of where the money goes. How is it possible to ever save up the money to drive the cash flow? It's not, or it's much slower. And so the reason I want to share these examples is I want to share my own mistakes. I'm a humble investor. I've come a long way. I've learned a lot. I'm always learning a lot. And so that's another thing. I don't want this video to come across that I have nothing to learn or I'm just putting down others. No, absolutely not. But I'm just trying to make it fun here as well. And I truly respect all of the videos, all the YouTubers, everyone responding to me. Bless you. You guys are awesome. Look, but I got to keep things fun here. And anyways, this is just another example of how to spend money. And boy, the money goes fast when you buy stuff like this. And when you do, pretty soon you don't have money to invest in the stock market. So learn from me. I've been there, done that. This is a lesson I've learned along the way, and I still like this stuff. And the beauty of this is I can continue to get some useful life out of these shoes. I take good care of them. I keep the shoe trees in them, keep them in real good shape, and just try to avoid buying too much of this stuff going forward. That's the goal. And certainly I made big changes in my ways. If I had to remember, these shoes honestly are probably, I can't even remember, they're old. They're probably 8 to 9 years old, maybe even older. And so that was the old Ian, and the new Ian is all about just being more and more frugal. And so anyways, I want to give a full disclosure before the video ends today. In terms of full disclosure, I own 3 of the stocks mentioned today. I'm about to probably buy in the next 2 weeks one of the others. I am long. I own stock in Procter Gamble, ticker symbol PEG, Southern Company, ticker symbol SO, and 3M, ticker symbol MMM. I am long. I own those stocks in my personal stock portfolio. Within the next 2 weeks, it is likely that I initiate a position. I take a position in Cedar Fair, ticker symbol FUN. Hey, before I leave today, one more thing just in terms of a disclaimer. Today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. And remember, this is not an investment at all. This is not an investment. Maybe it's an investment in one's happiness if one does it in extreme moderation. This is an investment in one's future, in one's passive income and cash flow. I will see you in the next dividend investing video.